The Forex market runs 24 hours a day, 5 days a week. But it does not run forever, and knowing exactly when it stops and what happens when it does can protect you from losses that catch unprepared traders off guard. Unlike a stock exchange with fixed opening bells, Forex is a global network of banks, institutions, and brokers spread across time zones. Trading simply moves from one financial center to the next as each business day begins. Tokyo hands off to London. London hands off to New York. This is why a Forex trader can place a trade at 2 in the morning on a Tuesday and find active pricing available. But activity is not constant. It rises and falls depending on which centers are open. The trading week is broadly divided into 4 sessions: Sydney, Tokyo, London, and New York. Sydney opens first around 10 p.m. GMT on Sunday, marking the start of the week. Tokyo follows, bringing stronger volume in pairs like US JPY. London opens around 8 a.m. GMT and is the most active session of the 4, driven by the sheer volume flowing through European banks. New York begins around 1 p.m. GMT and overlaps with London for several hours. That overlap, roughly 1 p.m. to 5 p.m. GMT, is the highest volume window of the entire week. Spreads tend to be tighter, and price movement tends to be stronger. For many strategies, this is the most practical time to trade. On the other end, the market closes for the weekend. The New York session wraps up at around 10 p.m. GMT on Friday, and trading does not resume in any meaningful way until Sydney opens again around 10 p.m. GMT on Sunday. That is roughly 48 hours of closure each week. That closure creates a real risk called the weekend gap. When the market reopens Sunday evening, prices do not always pick up where they left Friday. News over the weekend, political events, economic data, unexpected developments can push prices sharply in either direction. If you are holding an open position and the market gaps against you, your stop loss may not fill at the price you set. It fills at the next available price after the gap. That difference is called slippage, and it can mean a larger loss than you planned for. Many traders simply close their positions before the Friday close to avoid that uncertainty entirely. Public holidays follow the same logic. When London or New York observes a national holiday, liquidity drops, spreads widen, and price moves can become erratic. Keeping a calendar of major holidays in key trading nations is a basic but genuinely useful habit. Before you trade real money across any of these sessions, practice on a demo account first. Watch how activity shifts across the day. Get a feel for the rhythm. That preparation is free. The mistakes it prevents are not.